Hi, everyone. I'm Adrian Helfert, our CIO. I wanted to talk to you about the Federal Reserve meeting on September 17th that kicked off the easing cycle that we are now in. The easing cycle, meaning the Federal Reserve, the Federal Open Market Committee, decided to cut base rates by 25 basis points, what we would call one cut. What was expected was somewhere between 1 and 2 cuts, or really a priced in expected that they were going to ease. What I would tell you is we're just going to give you a short introduction to this, but it's most important not that they cut this time or how much they cut or whether they're going to cut 3 times versus 4 times or 2 times in this coming end of year cycle. But we're in an easing cycle. They're going to be accommodative to risk assets. That's equities. In some sense, that's corporate bonds as well. That's also potentially safe haven assets. And the neutral rate, that rate that the FOMC uses to balance their mandate of labor and inflation or stable prices and full employment, is likely going to be lower. That means they're going to continue on an accommodative path. They're going to continue to facilitate easy conditions for the overall market, to help housing, to help labor markets be strong, to help corporations have lower financing rates, lower capital cost. So we'll start to see more of that. What's the read-through that we got from the Federal Reserve? As an old school fixed income guy, I follow the Federal Reserve very closely. Interesting that we saw a little bit of a divergent opinion of many of the members on the Federal Reserve, or maybe just really expected given how much it's been involved in the political discourse of the day, of whether it's now seeing pressure from the political element, et cetera. But labor markets, number one, have taken a priority over the inflation mandate. That is the signal that we got from Chairman Powell, most certainly saying, this is the reason for easing this time around. It's not because of the concern around inflation so much, because inflation is still at an elevated rate. Usually you would keep policy rates elevated in order to keep inflation from rising further, but labor markets are experiencing a downturn. We're seeing unemployment rates rise. That's a concern for the Federal Open Market Committee, and they're responding accordingly. And what they're telling us, I believe, is that in the future, it's going to have a heavier weight on the labor markets. And because of that, we're seeing really easing as the new neutral rate, meaning the Federal Reserve is likely to continue to ease policy in order to facilitate growth in the economy. And we saw that through their statement of economic projections, where they often tell us that what their expectations are. Every quarter they do now. And they told us that they expect GDP growth to rise. They expected unemployment rates to drop. They're telling us at the same time they're easing, which means in the future, we're going to look for more accommodative. Let's talk about what this means for markets and for our positioning overall. For markets, that's a positive thing. In the near and intermediate term, equities certainly like that we're going to be a more growth-oriented policy from the Federal Reserve. So we should see capital costs drop. We should see, I believe, small and mid caps especially benefit from that. Ideally, they benefit from labor cost as well. These are more labor-centric companies. And should they see lower labor cost as a result, then that should help small and mid cap companies most especially. But generally, the equity markets should benefit from this. Bonds, a little bit more divergent on whether it's a shorter maturity or a long maturity. Shorter maturity bonds, we believe that we should see interest rates start to fall. Interest rates should start to fall as they're a little bit more controlled by policy. The intermediate areas like the 10-year US Treasury bond, uncertain, more of a growth-oriented asset. Rates go up generally to reflect growth. Rates go down to reflect potentially lower growth. We'll need to see the whites of the eyes of growth. The longer term maturities on the US Treasury, a little bit more concerning. Those are more inflation sensitive or inflation premium, the possibility that we might have higher inflation in the future. And if we relax the mandate on a concern if inflation goes higher and focus on labor, we're effectively saying we're going to push growth over inflation. And you could see a deteriorating valuation on longer term bonds. So in bond space, we should maybe look at corporate bonds that provide that incremental spread or that incremental yield over risk-free assets as a preference over US Treasuries. And then interestingly, we should be looking at some alternative-oriented commodity assets as well. That's gold. That potentially is cryptocurrency like Bitcoin. That no longer is cryptocurrency just the crypto bros. This is looking like somewhat of a safe haven asset or a stable value asset if inflation rises. Gold, most especially, has experienced an extraordinary rise this year, and we believe it could continue to do so. And if we see a deteriorating long bond valuation, yields are rising because there's a concern around inflation premium rising, gold should benefit from that. The longer term, we'll continue reading the outcome of what we are seeing here, but equities, this is a positive outcome for the equity space, and that we're pushing more of that growth potential out of the economy. Inflation premium is something we'll remain more watchful for, not only in where we own equities, but also in the bond space and how we own bonds, and also taking into account some of the alternative commodity assets that we could own as well. We'll keep looking at the space. We'll keep reading it for you. We hope to see you again soon. Thank you.